Every successful business out there, from the biggest global conglomerates right down to those hyper-growth startups, shares one absolutely inescapable reality. Capital is the lifeblood of scale. You simply cannot expand an operation or dominate a new market out of thin air. It takes serious resources, right? The grandest idea in the world means literally nothing without the fuel to execute it. Okay, let's dive into this. Where does that capital actually come from? If you have a company that's primed and ready to scale, how do you find that crucial fuel to make it happen? Well, today we are going to break down the exact mechanics of how companies bring in cash to power their biggest ambitions.
So, let's look at the basic definition here. Business financing is getting the money a company needs to start, operate, or expand. At its core, this is the engine that converts capital into operations. It's the definitive mechanism that turns a raw vision into tangible assets, hiring elite talent, and achieving massive market reach. Because let's face it, none of those vital activities happen for free, and this system is exactly what pulls the required capital into the company.
Let's start with Section 1, internal financing, which basically means using your own money. Think of this first major category of funding as tapping directly into your vehicle's reserve tank.
What we're talking about here is leveraging the company's existing profits or the owner's personal savings. And the profound benefit of doing this is absolute autonomy. When you use your own internal capital, you aren't creating any debt. You aren't strapped to a stressful monthly payment. You aren't paying a single dime in interest, and you definitely aren't answering to outside institutions. It's all you.
But of course there's a catch. That autonomy comes with a pretty steep trade-off: velocity. If you only ever spend what you've already earned, well, your growth is hard-capped by your current profits. If a massive, time-sensitive market opportunity opens up, say a chance to capture thousands of new customers, a low internal tank means you might just lose out to faster-moving competitors. That brings us to Section 2, external financing, or finding outside capital. If internal funding is your reserve tank, external financing is like pulling your vehicle right up to the gas station pump for a major refuel.
Now, what's really interesting about this slide is that it's definitely not a one-size-fits-all station. You've got options. You can secure traditional bank loans, attract private investors, pitch to aggressive venture capital firms, leverage modern crowdfunding, or even tap into government grants. But the absolute critical detail to remember is that each one of these different pumps comes with vastly different costs, distinct risks, and very different strings attached.
And that leads us perfectly into Section 3, debt versus equity. This right here is the absolute core dilemma that every single business owner eventually has to face when raising money. And this brilliantly illustrates the two sides of the coin. On one hand, you have debt. You borrow the cash and you get to keep 100% control of your empire. But you strap yourself to this heavy anvil of mandatory repayment with interest, totally regardless of how the business is actually performing. On the other hand, you have equity. You get the cash without that monthly burden of repayment, but the cost is permanent because you are actively carving out a slice of your company's future and handing it over to someone else.
So how do we navigate this? Let's move to Section 4, choosing the right path. The real trick is figuring out how a business actually decides between these options based on their financial health and their long-term goals.
Let's move to and see how this builds across a company's timeline. The right answer actually evolves as the company matures. In the early startup stage, the risk is incredibly high, which makes traditional bank loans super tough to get. So founders usually trade equity just to get off the ground. But fast forward to the growth and expansion stages, now with a proven track record and solid financial health, that exact same company can easily secure traditional debt, or maybe even grow large enough to issue public shares.
So the crucial point is really captured perfectly by this quote from our source material. Business financing is the fuel that helps companies turn ideas into successful businesses. Mastering the mechanics of this fuel, knowing exactly when to tap your reserves and when to head to the pumps, that is what empowers entrepreneurs to make smarter decisions for sustainable growth. It's quite literally what separates stagnant ideas from scaling successful empires.
Knowing how this entire machinery works and the profound trade-offs required to turn a mere vision into a living, breathing reality, well, it leaves us with one vital question to think about. When fueling your own business, are you willing to pay the price of debt or the cost of your ownership?